Welcome to this explainer. Today, we're jumping straight into a really detailed summary of a fascinating article that breaks down Kinder Morgan's financials. We're going to look under the hood at their business model, dig into the hard numbers, and figure out their true valuation. Basically, we want to know if this company is a safe dividend compounder you should consider for your portfolio, or if it's just an overvalued pipeline giant right now. And honestly, that question is the entire core thesis of the source article we're exploring today. Kinder Morgan is one of North America's premier energy infrastructure companies, and the market is constantly debating how to categorize them. On one hand, you've got these incredibly reliable cash flows, but on the other, well, you've got some massive debt and fairly limited growth. So let's break down the data to find out the real story. Here's our roadmap for this explainer. We'll be hitting 1. The energy toll road. 2. Financial strength and weakness. 3. Valuation and intrinsic value. 4. Risks and SWOT analysis. And 5. The final investment verdict. Let's kick things off with Section 1, the energy toll road, and understand Kinder Morgan's actual business model. The article makes a brilliant comparison here. You really shouldn't think of Kinder Morgan as an oil producer. Instead, think of them as a massive energy toll road. Just to put this in perspective, roughly 40% of U.S. natural gas flows through their systems. That is tens of thousands of miles of interconnected pipelines crossing the entire continent. They aren't out there drilling for oil, which is a super volatile game. Instead, they earn fee-based revenue from long-term contracts. They literally charge a toll to transport and store hydrocarbons. And that's a huge deal because it completely shields them from those wild day-to-day price swings we see in the commodity markets. Because of that setup, they have an incredibly durable competitive moat. It's built entirely on physical infrastructure that is, frankly, nearly impossible for any competitor to economically replicate today. I mean, think about trying to get the permits, the right-of-ways, and navigating all the environmental and political hurdles to build a massive new pipeline from scratch right now. It's incredibly difficult and expensive. Those massive entry barriers mean incumbents like Kinder Morgan are deeply entrenched. Add in those long-term contracts, and you've got exceptionally sticky customers like utilities and producers who have absolutely no choice but to rely on this infrastructure.
Moving right along to Section 2, financial strength and weakness. This is where we see a real tug-of-war between profitability and leverage.
There is a fascinating tension between their strengths and weaknesses here. On one side, you have incredible financial strength, $3.18 billion in trailing free cash flow. That is a massive, predictable cash machine that very comfortably supports their dividend payouts. But you have to look at the flip side. They are carrying $32.2 billion in total debt. That almost perfectly equals their total equity. That mountain of debt eats up about $1.78 billion in annual interest expenses alone. It's your classic infrastructure setup, right? Asset-heavy and highly leveraged. Which brings us to a really important figure, 0.52. That's their current ratio. If you're newer to this metric, anything below 1.0 means the company has more liabilities coming due in the next year than it has liquid assets to cover them. So 0.52 reveals a pretty distinct weakness in their short-term liquidity. It highlights just how reliant they are on that constant cash generation we just talked about, and their need to constantly refinance that debt. Why does this matter to you? Well, it means the dividend could actually be at risk down the road if interest rates were to spike out of control, making refinancing drastically more expensive.
So, knowing all that, let's jump into Section 3, valuation and intrinsic value. Is the stock actually priced right?
The detailed summary in the article runs the valuation models, and the results are pretty clear. At the time of the analysis, the market price was sitting at $32.25. But when the authors ran the discounted cash flow models, assuming a totally reasonable 6% growth and an 8% discount rate, the intrinsic value actually came in lower, between $28 and $31. The multiple-based valuation was even lower, showing $27 to $30. So averaging it all out, the true intrinsic value is roughly $29 a share. Bottom line, the shares are currently trading above their fundamental value.
And we can confirm that slight overvaluation from another angle using the PEG ratio, which sits at 1.59. It's a fantastic metric from the article that takes the standard PE ratio and adjusts it for both growth and the company's 3.73% dividend yield. Typically, a PEG ratio right around 1.0 means you're looking at fair value. So a number as high as 1.59, that strongly suggests the stock is on the expensive side right now, especially considering their mid-single-digit earnings growth.
Which leads directly to this absolutely crucial point. Buying at current prices gives you a negative 10% margin of safety. When you invest, you really want a buffer, a discount to the true value, just in case your growth assumptions are a little too optimistic. If you buy Kinder Morgan today, you're actively paying a premium for that toll road stability. The market obviously knows how safe the cash flows are and has priced the stock accordingly, literally leaving zero margin for error.
Let's shift gears to Section 4, Risks and SWOT Analysis. What could actually go wrong here?
The source article puts together a really insightful weighted SWOT score, and Kinder Morgan comes out with a 7.1 out of 10. That's a solid score for sure, but it's not perfect. It essentially shows that their immense strengths, that irreplaceable pipeline moat and those super stable cash flows, still heavily outweigh their weaknesses, like the slow growth and that heavy debt burden. Overall, the underlying business is incredibly robust.
But we really can't ignore the external threats. As we noted with that low current ratio, rising interest rates are a huge headwind because they inflate the cost of refinancing their mountain of debt. On top of that, strict regulatory pushback makes expanding their network a real headache. But the absolute biggest existential threat? The long-term energy transition and decarbonization. Think about it. If the world aggressively moves toward electrification, what happens to tens of thousands of miles of natural gas pipelines in 20 years? Asset utilization could take a serious hit over the long haul.
All right, bringing it all together in Section 5, the final investment verdict and our actionable strategy based on the data. The detailed summary maps out 3 very distinct scenarios to set our expectations. In a bear market with sluggish 3% growth and high rates, intrinsic value drops to the low 20s. The base case, where they just keep chugging along as a stable compounder, puts the value right at that $29 mark. The bull case is what's really fascinating. To actually justify buying above today's price of $32 and hitting a value of $40, you have to assume a massive sustained boom in liquid natural gas exports, plus lower interest rates and 7% sustained growth. Without all those specific stars aligning, the current price is definitely a bit stretched. So what's the actual game plan? Well, if you're an income investor targeting a solid 9% annualized return over the long haul, the article lays out the exact math. At the current price of around $32, you are firmly in hold territory. It's a fantastic company to own for those stable dividends, but it's not the right place to deploy fresh capital if you want market-beating returns. To hit that 9% target, you've got to be patient. You need to wait for the price to drop into that $22 to $25 buy range before you aggressively add to your position.
So I'm going to leave you with this final thought to chew on for your own portfolio. The data clearly shows Kinder Morgan is an incredibly reliable toll road, but the broader market already knows that. So are you comfortable paying a premium right now just to lock in a stable yield, or do you have the patience to sit on your hands and wait for that optimal $25 entry point so you actually have a margin of safety? Think about how that fits into your own personal strategy. Thanks so much for joining me for this explainer, and keep learning.